you've got 467,000 jobs. You mentioned the expectations call for 150,000 jobs created for the month of January. Markets right now are trading mixed ahead of the unemployment rate, but 467,000 jobs created in the month of January is a much better than expected number than we were expecting, with an estimate at 150,000. The unemployment rate expected at 3.9%. What do we have here? We've got a number of 4% on the unemployment rate, so that's certainly a little worse than expected. James Freeman with me this morning, Wall Street Journal editorial page editor. Your thoughts on what we're seeing right now?
Yeah, that's a shockingly good number. I mean, still leaves us well below, probably, I guess, 1.5 million or so below pre-COVID employment. But given the other data we've seen, with the difficulty of businesses to find the workers they want, other surveys, I think ADP had a loss. The NFIB Small Business Survey yesterday had it basically flat. So, yeah, 467,000 would be shockingly good and kind of a head scratcher, given that everything's going on right now.
Liz Peek, Lisa Erickson, Stephanie Pomboy, Steve Moore, John Lonsky, John Hilsenrath, Joni Biley, and Austin Goolsbee joining us this morning on these jobs numbers. 467,000 jobs is a major beat. Liz Peek, your thoughts, as we were expecting 150,000 jobs.
Yeah, the consensus was 150. I thought we'd lose jobs, Maria, particularly after the ADP number came out as a minus 301,000. I think there's going to be a lot of questioning of this number. I'm not even sure it means very much. It either it reflected the Omicron surge or it didn't. But I really think the market's going to kind of just shrug it off and kind of focus on earnings. That's really what's driving stocks here.
You know, it's interesting because, Stephanie Pomboy, we were talking about some better than expected earnings in an environment where the Federal Reserve is worried about inflation and the potential for a slowdown in the economy. Your thoughts on this report?
Well, the first thing I would say, I would sort of underscore Liz's reluctance to draw too firm a conclusion on this number. In January, the economy sheds 3 million workers seasonally. So the idea that the BLS can measure a change in the employment, to the nearest 1,000 is sort of laughable in normal circumstances, but never more so than in January when there's that 3 million turn in the workforce. That said, yeah, I mean, I guess you're looking at it in the Treasury market. Yields are backing up sharply on the idea that this keeps the Fed on this hawkish tilt. And as you've heard me say time and time again, I think as ever, they are tightening into a slowdown. The opportunity to have tightened has passed. And this number notwithstanding, we've seen the peak in growth in economic activity and corporate profits, and I believe inflation. So, they're closing the barn door after the horse has already left. And the problem is that given the bubble they've inflated in all this time, that's bound to create some real turmoil in the markets. But here you have the 10-year at 188. So, clearly we're going to see a reaction here that anticipates a much more aggressive or, the 6 to 7 rate hikes that so many people are forecasting for the Fed this year.
Well, that's exactly right. We're seeing this market react in a big way. You've got the yield on the Treasury, the 10-year Treasury, up almost 5 basis points right now. Stephanie, up 4.7 basis points. You got stocks plummeting. Dow Industrials down 269 points. The Nasdaq has gone negative. It is down 16 and change right now. S&P down 22. Lisa Erickson, let's walk through some of the key points in this report. Not just the fact that we saw 467,000 jobs created for the month. Wages are up 4%. The labor participation rate coming in at 62.2%. Your takeaways?
Well, overall, from an economic standpoint, it certainly is a nice report. It's nice to see that jobs held in there, despite the fact that actually over the mid-month period in January where it was measured, we actually had a height in terms of Omicron cases. So the fact that we still got some nice hiring numbers is encouraging. And I would also look at those wage numbers and participation numbers that you just pointed out, because what we're seeing on the wage side is we're still hitting that Goldilocks sweet spot where we're getting some increases in wages to help keep up with the inflationary pressures that are present, but we're not seeing elevated, extremely high wages, which could further lead to a wage price spiral. And then on the participation side, that's actually very encouraging that we saw a tick up in that rate. Obviously, we've all been looking for more and more people to go back into the labor force because ultimately that will really help to address some of the supply side issues. I would highlight, though, one thing that Stephanie pointed out, in that, these numbers may take a little while to sort through, both because of seasonal adjustments and also because there are some annual revisions that the BLS, or the Bureau of Labor Statistics, makes to its figures to reset and make those figures more accurate. So again, there could be a little bit of noise in the numbers, but again, from an economic standpoint, the figures look good. I think, again, just looking at the markets, though, that could be a little bit of bad news for the markets, as it could strengthen, some of the Fed's result again towards normalization.
Yeah, and that's the point that Stephanie was making a moment ago. John Hilsenrath, jump in here. I'm also struck by this wage number of 0.7% versus an estimate of up 0.5%. What's most important to you, John?
Well, so, there are a few numbers that jump out at me here. I've had a chance to look through some of the report. As you mentioned, the labor force participation rate was up to 62.2%. That's a surprise, because I thought this report was going to be the Omicron report, with people staying home because of this resurgence of Omicron. But it looked like we have more people coming into the labor force, which is a bit of a puzzle. I think we have to be careful over interpreting these numbers. But that's good news from the Fed's perspective. They want to see people coming back into the labor force. It was also the case that the employment to population ratio, the percentage of the population working, rose to, 59.7%. And wages were also up from a year ago, 5.7%. So there's a lot of kind of strong indicators in this report. Because it's January, because it's the Omicron month, I think we have to be careful over interpreting. I think there's an element of Goldilocks, but I'm not ready to declare it that, because of all these disruptions that we're talking about. One other point I would like to make is, we have the Olympics going on right now, and I think that's also causing disruptions in the global economy, because China just shut down so much of its factory floors to get to the zero tolerance policy. Hopefully later in the year, when Omicron passes and if China decides to open up again, these numbers will look even better.
Yeah, it's a good point, John. But, the other day, Nancy Lazar was on this program saying she's expecting a global recession in 2023, not just because of the U.S. and a slowdown, but because of the rest of the world.
Well, I think a lot depends on the Fed. If the Federal Reserve overdoes it on raising interest rates, they could drive us into a recession. And that leads actually to the next point I would make, which is that, for me, the watchword right now in the markets has to be volatility. The first Friday of every month for the next few months is going to be a very volatile time for the markets, because the Fed doesn't know how far it's going to have to go on raising interest rates, because it doesn't know how Omicron is going to play out. It doesn't know how much late workers are going to come back into the labor force, how these supply shocks are going to hit the markets, how China is going to open up. There's so much uncertainty. I think that volatility is what we're going to see in the markets.
Yeah, and Steve Moore, that's why you've got such a nervous market. NASDAQ down 11% year to date. Dow and the S&P 500 also declining year to date because of this uncertainty about the economic macro story, but also about whether or not the Fed is going to be able to pull this off easily.
Well, I have to say this is a very, very strong number. No question about it. It surprises me greatly. I'm shocked at this number. A couple of things I would say about it. Number one is it seems to contradict Maria, so many of the other signs of the economy, which over the last 5 or 6 weeks have been really weak. You know, industrial production numbers, retail sales numbers, capital spending numbers by businesses. So I have to say I'm a little perplexed. There's a new feature in this report, and I haven't had a chance. I was just glancing over it. It looks to me like they did revisions of the numbers for 2021, and they revised those jobs numbers down fairly significantly, if I'm reading that report correctly. So that's kind of an interesting development. But the other thing I don't know about it, which I would be curious about, is the revisions. I was looking for the revisions for the previous months because it's just perplexing.
I'll tell you, the November revision is very strong. We've got a big revision in November from 267 all the way up to 600 and change on the revision.
Wow.
So November is being revised up very strongly right now, Steve. So that's certainly one thing that I noticed and will point out.